Hello, my name's Rob Nixon. I'm the CEO and founder of the Proactive Accountants Network. For 19 years, I've been advising accounting firms on how to run a better business. And this series is all about your revenue, your profit, and your cash. Part 1 is all about productivity or utilization rate. As in, we're hiring these people and we pay them for X amount of hours per week. How much of that time that we pay them for is being utilized in productive work for clients? So around the world, this seems to be about 60–65% of the time that they're actually working. It's not enough, particularly when I see that work in progress levels are very high. So the assumption, first of all, to increase productivity or utilization rates is the assumption is that there's enough work to do. So if there's enough work to do and they're only putting 3 days a week on the clock, so to speak, what are they doing for 2 days a week? What do they actually do when there's loads of work to do for 2 days a week? I don't get it. So I start asking the question, so what do you do? I ask accountants, I ask partners, I ask anyone involved in chargeable or billable time. And typically they tell me they're doing things that can't be charged, or they think they can't be charged. So they actually are working, but don't put that time on the clock in the first place. And this, by the way, is before we get to write-downs or indeed our realization rate. So, first of all, do we have enough work to do? If we do, then productivity or utilization rate should be extremely high. Secondly, is that person doing what they're supposed to be doing? I find in working with accountants around the world that most accountants spend up to 2 hours per day per person doing things they shouldn't be doing, like administration work, like checking in work, like checking out work, like finding misinformation from clients, like hunting it down. Things that other people should be doing. So if we had the right people doing the right things, and accountants, bear in mind what they signed up for, they signed up to be an accountant, not an administrator. So if accountants were doing accounting work, not administration work, and we had the right amount of work to do, then that number should be much higher. We should be at least 4 days out of 5 as far as productivity or utilization rate. And that's only working, let's say, a 40-hour week. One of our other strategies is to price every job up front. See, in a price and arrears model, accountants are often fearful of putting too much time on the clock because it'll get written down. So if you price everything up front and you actually have an hour's budget per job and you drive the time down, the incentive should be just put all time on the clock. All time on clock. You see, the accountants on a price and arrears model are fearful that the bill will be too high for the client. If you sort that out at the outset, as in price it up front, that goes away. Just put the time down. Keep the timesheets. But get rid of the charge rates. We'll get more into that when we get to our average hourly rate and our net firm billing rate. But then you have an efficiency program. You follow our 18-step workflow system to get super efficient. So your capacity is real. With productivity or utilization rate, it should be around the 75–80% mark for the time that they're working, provided we have enough work to do. But if you're pricing in arrears, seriously, if you are pricing in arrears, you'll never do it. Because the accountants will make a decision at the time of doing the work whether they put the time on the clock or not. Hope you've enjoyed this short series. For more information, you should download our report or send us an email to report@proactiveaccountants.net. We've got all 12 topics covered in detail. And as a bonus, we'll also send you what's called our accountant strategy map, covering 488 separate projects that accounting businesses can implement, and you can do the same for yours. You can implement these projects and improve your utilization or productivity rate. I'll see you in the next part.